Hi friends, welcome to my YouTube channel. In this video, we will discuss about the rising interest rate scenario for banks and the situations like happening like Silicon Valley Bank collapse, and we will discuss how the Indian banks are not vulnerable to the crisis like Silicon Valley Bank in the rising interest rate scenario. Let's first understand the banking business model. See, banks have simple business model. They take the deposits from people like you and me for lower rate, and they lend to people like people to higher interest rates in the form of car loan, personal loan, and etc. And some of these deposits they raise from us, they have to keep with RBI in the form of SLR and CRR ratios, and out of that they should need to allocate some money to also private priority sector lending, and out of after all completion of this they need to park their extra money into buying bonds, government deposits, government securities. So let's first and after in buying also, but things could go wrong because if all of the money got uh, lent to the people, they could turn into be NPS. So the bank has to keep some park money for emergency purpose, and then they will invest in government securities. Hmm. When people see this happening, the folks borrowed who might default, the people will run to the bank to take deposits out from bank. This is called a bank run situation, and they might have to sell the bonds which have which the banks bought in the initial stages. So when the RBI, when the central banks raises interest rates, the value, the bonds previous, they issue bonds for new higher interest rates. So the old one which gives lesser interest might see some forced selling. That means the price will get reduced, and the users and the people will buy new bonds with higher rate of interest. So this will create short-term pressure on this will create pressure on old bonds. Mandated the banks to uh, typically 20 to 30% of the bank deposits are used to buy the bonds in case and these are categorized into three categories. That one is for held for trading and available for first one held for trading, second one available for sale, and the third one is held to maturity. In the first two cases, the banks are mandated